Welcome back to the Deep Dive. Today we are cracking open the Palo Alto Networks Q1 2026 earnings report. But this isn't just about revenue beats. It's about a massive strategic pivot, really, fueled by AI threats and the ticking clock of quantum computing.
That's exactly it. Our mission here is to get past the headline numbers pretty quickly and really understand the fundamental shift that's happening. We'll look at the numbers, sure, but also why the market was a bit hesitant, and most importantly, unpack their huge bets on CyberArk and now Chronosphere.
Okay, so let's jump right in. The numbers for the quarter ending October 31st, 2025, they look strong.
Very strong across the board.
Revenue hit $2.5 billion, which, surpassed the $2.46 billion forecast. That's a healthy 16% year-over-year growth.
And on the bottom line, EPS was solid too.
Right. Adjusted EPS came in at 93 cents against an expected of 99 cents, a 19% increase. So everything's looking green.
Exactly. Strong beats pretty much everywhere. And yet if you were watching aftermarket trading, the stock actually dipped.
It did. It was hovering, between 0.5%, almost 4% down at points?
Mm-hmm.
And that's the paradox, isn't it? Why the cautiousness from investors when the numbers are just, undeniably good?
I think investors are always looking forward, right? The past quarter was great, but the market sees two things at once. One, heavy investment in AI and platform expansion. And two, the financial impact and integration risk of not one, but two massive acquisitions.
CyberArk and Chronosphere.
Exactly. They're looking at future profitability, but through the lens of this huge immediate cash outlay.
That makes a lot of sense. But if we look at the core metrics, the ones that indicate future health, it tells a story of fundamental strength.
It absolutely does. I mean, look at Next Generation Security, their NGS annual recurring revenue.
That's the cloud and security operations platforms.
Right. And that grew 29% year over year to hit $5.85 billion. That kind of growth shows real traction where it matters most.
And the number I always look at for long-term commitment is the RPO, the remaining performance obligation.
Yes, the RPO, essentially the contract backlog. It grew 24% to a staggering $15.5 billion.
$15.5 billion.
Yeah. And for you, the listener, in a world where budgets might be tightening, a backlog that big suggests customers see this as a non-negotiable infrastructure investment, not just discretionary spending.
It's a huge vote of confidence. What about profitability?
Yeah.
Because they continue to execute really efficiently even with all this spending.
They do. Their operating margin expanded by 140 basis points to 30.2%. That's the second quarter in a row they've been above 30%.
And maintaining that kind of discipline is what keeps the big investors comfortable.
It's what lets them make these large bets.
So Q1 was strong. What are they expecting for the next quarter?
For Q2, they're guiding revenue between $2.57 and $2.59 billion. So that's about 14 to 15% growth. NGS ARR, their growth engine, is expected to grow 28% to over $6.11 billion.
And EPS?
EPS should land between 93 cents and $0.95. So it all looks like continued steady execution.
For the full fiscal year 2026, the big picture.
Full year revenue is guided between $10.50 and $10.54 billion. Still that solid 14% growth. But here's the kicker that ties back to that market paradox. They reinforce their confidence in achieving over 40% adjusted free cash flow margin by FY 2028.
Wow.
And they explicitly said this target is inclusive of the two pending massive acquisitions.
So they believe they can digest these huge companies without breaking their long-term financial model.
That's the message they're sending.
Okay, so this steady execution, it's not random. It's driven by a core strategy they call platformization.
Right. And this is the key reason they're winning those huge multi-million-dollar deals.
We hear that term a lot, platform. But what does it actually mean for the listener? In simple terms.
It just means consolidation. CISOs are tired of having, 40 different security products from 40 different vendors. Platformization means moving everything network, cloud, security ops onto one integrated system. It reduces complexity and lets the systems actually share intel in real time.
And we have evidence this is working for them right now.
Absolutely. They did about 60 net new customer platformization deals in Q1 alone. And you see it in the big wins, like the $33 million SEC deal with a major U.S. cabinet agency.
For 60,000 seats.
60,000. And the critical detail there is that they displaced a major incumbent vendor.
Which is a huge undertaking for an organization that large. It shows massive confidence in their solution.
It proves the platform argument is compelling enough to force that kind of painful transition.
And speaking of eye-popping deals, there was a huge one in the security operations space.
Right. The $100 million deal with a large U.S. telecom. And what's fascinating is the breakdown. $85 million of that was specifically for XC.
Let's pause there for a second. We said XEM a few times. What is it and why is it worth $85 million to a telecom?
So XC is their advanced security operations brain. It's designed to automate threat detection, investigation, and response. It moves security teams from manual reactive work to automated data-driven outcomes.
So the goal is just pure speed.
It's all about speed, and the outcome is undeniable. Over 60% of their XM customers have reduced their mean time to respond, their MTTR, from days or even weeks down to minutes.
Which is everything when threats are moving at AI speed.
It's the only way to survive. And the platform is sticky. They have about 470 customers, and the average ARR per customer is over $1 million.
Incredible. Beyond SaaS and XM, you mentioned a hidden gem.
I did. It's the growth in their software firewalls. Product revenue there grew 23% YoY, and now nearly half, 44% of their trailing product revenue comes from software form factors, not physical boxes.
Which points to a deep, ongoing infrastructure modernization cycle.
Exactly. As companies build out massive cloud and AI data centers, software firewalls are providing that essential protection at scale.
Okay, so that foundation is solid. But the next phase is about spending billions. And the future is moving terrifyingly fast. The CEO was quoted saying, and I think this is chilling, AI attackers are here now.
That urgency is driven by a very specific event. The recent reported case of an AI agent autonomously conducting a nation-state cyber attack. We've moved beyond hackers using AI tools. We're talking about AIs executing attacks without human intervention.
Which changes the game entirely. You can't defend at human speed anymore. This brings us to their big acquisitions. Let's start with CyberArk.
Right. CyberArk is focused on identity security, and it's set to close in Q3. The rationale here is that the definition of a threat is changing. They see an autonomous AI agent as a problematic insider threat. So identity security becomes paramount for controlling all identities, human and machine.
Identity is the new perimeter.
That's the idea.
And then, just announced, the intent to acquire Chronosphere for $3.35 billion. This throws them deep into the observability market. I have to ask, where's the investor pushback on spending this much while the CyberArk deal is still pending?
And that's a fair question. It's exactly why the stock dipped. The market is weighing the cost and the difficulty of integrating two giant companies at once. But the company's argument is that Chronosphere solves a foundational market failure that has to be fixed for the AI era.
What market failure is that?
Observability. The tools we use to monitor data from apps and infrastructure, they just weren't designed for the gigawatt scale of AI and cloud. Existing solutions have become, in their words, cost prohibitive. Chronosphere is designed for massive data volumes at, reportedly, a third of the cost of competitors.
So Chronosphere gives them the cheap, limitless data firehose. How do they turn that into defense? That's where their new platform, Agentix, comes in.
Precisely. They announced Agentix, which is a new layer of powerful, specialized AI agents for security. The synergy is key. You combine Chronosphere's real-time data monitoring with Agentix's autonomous problem-solving. You go from passive monitoring, looking at a dashboard, to active, autonomous remediation.
So Agentix sees a problem in the data stream and just fixes it.
Instantly, at machine speed. That's the vision of autonomous security.
Okay, let's shift from the AI threat to the next big inflection point, quantum computing.
The company is treating quantum as an immediate existential threat, and with good reason. The timeline is really tight. Commercial quantum computers are expected by 2029. But the real danger is harvest now, decrypt later.
Explain that for the listener.
It means nation-states are already stealing and storing massive amounts of encrypted data today.
IP, military secrets, everything.
Everything. They're banking on the fact that once quantum computers arrive, they can just crack today's encryption instantly. So enterprises have less than 5 years to get their entire digital estate ready.
So it's an urgent 5-year overhaul. What's their response?
A three-pronged strategy. Discover, protect, and accelerate. Discovering means using new tools to find cryptographic risk. Protecting means upgrading infrastructure, like their new Gen 5 firewalls. And accelerate means deepening their partnership with IBM to help enterprises migrate to post-quantum cryptography, or PQC.
They want to be the main partner for that transition.
Yeah. That seems to be the plan. And these bets, identity, observability, quantum, are all about dramatically expanding their scale.
How much scale are we talking about?
They're projecting their total addressable market, their TAM, will expand to around $300 billion by 2028.
The $300 billion, that's enormous.
It is. They're adding identity security, which they see as a $47 billion market, and observability, another $32 billion to their core markets.
And this ambition is reflected in their long-term financial goals,
Yeah.
specifically that ARR target.
Absolutely. They raised the FY 2030 NGS ARR target from $15 billion up to $20 billion. That's a huge jump. It signals immense confidence that they can integrate these new companies and cross-sell their solutions into their massive existing customer base.
And despite all that ambition and cost, they keep coming back to that 40% free cash flow margin.
That's the anchor for investors. They're committed to hitting that 40% plus margin by FY 2028, even with the two big acquisitions factored in. The message is, be patient. The payoff is a much larger, more resilient company.
So the narrative is clear. Strong quarter, great core execution, but the real story is this aggressive response to the dual threats of AI attackers and quantum decryption.
Exactly. The future of security is about real-time, autonomous response, and that requires unifying security and observability data at a massive scale. That's the bet they're making.
Which leaves us with a final thought for you to consider. If AI agents are already executing nation-state attacks at machine speed, how quickly does the industry have to move from just patching products to building fully autonomous platforms just to keep pace? And given that harvest now, decrypt later risk, are you treating post-quantum cryptography readiness as an immediate 5-year priority? Or are you waiting? Because it's really no longer a theoretical risk.